Welcome to Straddle Income. We're here to help you make money every day. This week, we're going to focus more about options and really high level, what is option and how do you really trade it and approach it. So the option concept itself and the general high level on how option works is going to be the focus of the video. If you wanted to know why you should consider trading options and what kind of benefit it will bring you, making sure you look at the videos from my channel last week and the week before where I talk about specific strategies, how you make money using options. But here, I want to take a step back and to really making sure I understand the option concept to start with option trading. And option trading, I want to start by talking about a real life example. So the example I'm going to share is about car insurance. I think everyone is, have some familiarity with the car insurance concept. You're paying a premium to the insurance company to cover your cars. So the service is, the contract, the coverage. There are several big parties in this transaction. So you have the buyer, which is yourself. You're paying for insurance. And you have the seller who is providing the insurance for you. So you have the insurance company. And number three, which is the asset being insured. And in this case, it's the car. I just want to stay high level. If you want to focus on details, there's, you can protect yourself. You can protect the other parties. We can talk about insurance durations. I don't want to go into too much details, but high level, these are the three things that transaction has. And this example, we're talking about protecting your car, right? What if you want to protect your stock? Stock is also an asset for you. That's your investment. That's your asset. And that's where the concept of option is coming from. Option is really about providing insurance on the stock that you have, you own. It provides the coverage. So in the option transaction, there are also three different parties. You have the option buyer, which is in the car insurance example, it's yourself. You have the option seller, which is equivalent to the insurance company. And instead of a car that's being insured, you have the stocks, which is the underlying asset to be insured. And the service is really simple. As the buyer, you pay the seller for the insurance on the stock as a coverage. Again, this is a really high-level concept. I want to make sure everyone is having a strong understanding of that. Option is about providing insurance and a contract. Okay? So let's talk about in detail how it works. And go back to our car example. When, for example, you have a good long weekend and you want to take a drive to a national park, you're having a good time, you're listening to your music on the highway, and all of a sudden your tire, exploded and your car lost control and you hit a tree. I'm sorry, but the good thing is you have the insurance. So you pull your phone, you call Allstate, they come here, they check out your car, and they pay for a couple $1,000. And instead of paying everything out of pocket, you have the insurance company here to pay for you. So in this example, in the car accident example, you have the right to ask insurance to pay for the damage happened to your car. Now let's look at the stock market. Say instead of a car that you own, you have 20 shares of Tesla stocks. And those are the assets. You want to protect yourself in case a black swan event happens, like the coronavirus, like the fact that Elon Musk decided to move to Texas. So you want to protect yourself. So as a buyer, you have the right to ask option seller to pay for the loss in case any big events unexpectedly happen. So the example here is if the stock goes below to a certain limit, you want to protect yourself by buying an option contract. Does that make sense? I hope it really makes sense. If not, making sure to leave a comment down below so I can help explain it further. For just a side note, I'm not saying that Tesla stock will drop because the fact that Elon Musk decided to move to Texas. That's a different story. So don't trade on that. It's a rumor. If you don't know what you're doing, you're gonna lose money. Okay. Now we're gonna go to a real life example. How option really works in action. You're interested about Tesla stock. The stock is currently traded at $790. In the scenario A is you're not sure. You think the stock could go higher, but you don't know. You want to buy, but you're not sure if it could go higher. So you buy some. You want to protect yourself. If Tesla goes above $790, you still want to not losing the opportunity to buy Tesla at $790. So you want to have something called the right to buy at $790. Right? In this example, it's the call option. When you have a call option, it gives you the right to buy a certain stock at a certain price. Now let's look at scenario B. In case you own 20 shares of Tesla stock and you want to protect yourself, you own them. Say, for example, you have those you purchased at $790. If Tesla goes below $790, you lose money. And you want to make sure you're protected. So how do you protect yourself? If it goes to 700, 600, you want to make sure you can still sell it back to the market as $790, to make even, to break even. So what you do is you purchase a put option. The put option gives you the opportunity and ability to sell at $790. So that's really the beauty of options. It protects your stocks, help you hedge. And in the future videos, we'll talk about how option really can help you make money. But that's a side story. Really, option fundamentally is to provide insurance and provide you the way to protect your stock. So I want to take this pause here, making sure you understand. And in the meantime, I want to make sure that you like the channel by clicking the subscribe button, and I really appreciate it. Okay, now let's look at how you actually trade options. And don't worry, this will look much simpler after I finish explaining it. So pay attention to this chart. This is the chart from the Thinkorswim, the trading platform. If you don't know what Thinkorswim does, I really highly recommend you look at the video from last week. And I put a link down below. I talk about how you can set up options on some of the popular trading platforms. So coming back here, this is the Tesla we're talking about. It's being traded at 811. This is the screenshot I took a couple of days ago. So this is the current stock price at 811.29. And pay attention to this date here. Just like in the real life, you have insurance that has expiration date. In the option contract, it also has expiration date. You have the June 12, 2020, the option will expire. And then you have the weekly and quarterly, we can talk about this later. Basically, when option first started, every option contract expired by quarterly or monthly. But now more people are trading it, we have weekly option contracts. Okay, don't worry too much about that. And go back to the car example. You remember you have 3 different parties, right? You have the car, you have the buyer, you have the seller. So in the car example, the things you want to protect yourself is the stock, Tesla stock price. So you want to make sure you can protect yourself at different level of the stock price. So you want to protect yourself at 775, 770, 765. These are the strike price. So just to quickly go back to the example here, this is the thing you want to protect yourself. And that's the number showing on the strike price here. Here is expiration date, and here is bid and ask. Really, it can be very confusing. Bid, by definition, is the price to receive when you sell the insurance. So bid is where it actually becomes an insurance company. You sell the insurance to somebody else, and the premium, the payment, somebody else is paying you. And the ask is you're buying from somebody else. You are the buyer, you're the car owner, you want to insure your car, so you pay a price to buy the insurance. Okay. So that's a screenshot, but I really wanted to take you to the trading platform. This is a Thinkorswim simulated trading. It's a paper trading platform, and I highly recommend it. It helps you to get familiar with the option, how really everything works. So Tesla stock price, again, at this time right now. So you have the option contract chain here. You have different expiration date. You have from May 15 all the way to June 17, 2022. So let's look at example. I think we will look at the June 26 example. Here are all the options that will expire on June 26, 2020. Here are the strike price, and here's the bid ask. Again, it can be very confusing, but Thinkorswim does a really good job to help you understand. So you hover your mouse, you see that button right there, the buy. So this is where you click it. When you click that, you're essentially buying the option. When you click the bid column, you're selling the option. So it really helps you to understand whether you're the buyer or the seller. Okay. So coming back here, bid and ask. Bid is when you actually sell, the money you're collecting. The ask is when you actually buy and you're paying for someone else. I hope that makes sense. All right, now moving on. Let's talk about how do you approach options. Again, there are 27 different option strategies. I don't want you to pay too much attention, but really, if we look at how you approach options, it's very straightforward. There are 3 steps you need to follow. Number one is the very critical one, is that do you want to be a buyer or you want to be a seller? Do you want to be somebody to buy an insurance for your car, or do you want to become the insurance company? And there's a very easy way to determine that. So there's a low volatility, there's a high volatility. The volatility is indicating how volatile the stock is. And that's the number you're seeing here, 79.70% volatility, 86.77%. But the true indicator is this thing right here, called IV percentile. That's 32%. So I will have a video talk about IV later, but really IV percentile tells you whether this thing is being traded at high implied volatility or low implied volatility. Using this number and look at the chart, it's borderline between minus less than 30 and then the 30 plus. So that number will help you decide if you want to be a buyer or seller. This is step number one. Step number two is you have to have a sense of the overall direction. If you're the buyer, you got to have a sense of whether the stock will go up or down or going to stay sideways. And when you're a seller, you also have to have the bias or understanding or prediction of whether the stock will go higher, it's going to drop. So that's number two, the steps. And then number three, that's when you actually pick the specific strategies for each of the direction you're going. So again, I'm not going to focus too much on the strategy. We'll talk about each strategy later. But really, the 3 steps that you're going to do before you approach any option contract is you think about, do you want to be a buyer or seller? What's your direction? And what's your strategies? The strategies could be, some put spread, buy shorter call, and a call ratio. Don't worry too much about it, but here is the way to approach. You start here, you become a buyer or seller, you do a directional, and then you pick a strategies, plain and simple. Okay, that's a lot. I want to stop here. I want to make sure you understand, have a clear understanding of the option. Really, option is insurance, a contract to help you protect your stock investment. In the future, we'll talk about how you can use the option to make money with specific strategies. So make sure you come back to this channel, subscribe, and come back to visit specific strategies that you can use to make money. For now, trade safe and do your own due diligence, and we'll see you next time.